Um, Good morning, everybody. We know here in Mexico, a lot of people likes to be late, but because of all the people here in the audience that are on time, we will start at 9:05. This fourth conference in finance. Every year since 2012, we've had this conference at ITAM in the first week of June. And this year, for the fourth conference, we have the honor to have with us Professor Myron Scholes, who is the 1997 Nobel Prize in Economics. He now is in Stanford University in the Graduate School of Business and is the Frank E. Buck Professor of Finance Emeritus. He taught before in the MIT and the University of Chicago, from where he holds a PhD and an MBA. He is currently in the board and has been in board of several investment vehicles and corporations. Now he's chairman of the board of economic advisors of Stamos Partners, and previously he was chairman of Platinum Grove Asset Management and on the Dimensional Fund Advisors Board of Directors and many other companies. And we're very happy to have Professor Scholes here. Thank you very much for taking the time to come to Mexico City and giving the keynote address to this fourth conference of finance. Professor Scholes will make this presentation about benchmarks, tracking error, and investment decisions. So thank you very much, and the floor is all yours. And please give Professor Scholes an applause.
Thank you very much for getting up this early in the morning. It's early for me too. So I just came back from China last Sunday, so I'm not exactly sure what time zone I'm in, because but we'll try to accommodate at this hour. And given my age, actually, what I'd like to talk today about is some recent work that I have done and papers on my website on tracking error and the cost of benchmarking. But I'm really going to extend that today, and what I'm going to talk about today, and some things that I've been really interested in, and how investment's working. And I think the world is changing. The things that me and others had argued for many years as a way to judge performance and to judge the way investment managers perform, I think is wrong, and causing us to have quite a difficulty in investment management. So I think we're starting to move away from these ways in which we looked at performance and try to think about new ways. And so I'm trying to think about what the cost of our current ways of thinking about investment performance are, and seeing as the germs of thinking about of other things to concentrate on. I had lunch with Alan Greenspan about a couple of months ago, and talking about rational markets and how markets move. And I really got thinking about that in context of my research that I've been working on recently. Greenspan's view that there's a lot of irrationality in animal spirits that cause people to deviate, I do think have to do a lot with benchmarking, or the idea that the herd controls what we do. And it has a lot of work as well, and influence in thinking about benchmarking or herding or going along with others. It has a lot to do with what we talk about in finance. Finance is based on uncertainty, or how to handle uncertainty. And a lot of the behavioral economics and behavioral finance world doesn't really take account of uncertainty to start with and how we tend to deal with things. So what we found in my paper, which I'm going to get to in a few minutes here, is that basically to deviate from the herd or deviate from others in a benchmark, that the reward to risk of doing so must be very high. If the reward to risk is not high, why deviate? And so the interesting part in a lot of experimentation that we do, given every model that we have in life has an error to it, and there's uncertainty associated with our models, then you have to take account of not only people's willingness to deviate or do things, but also the error, and you have to take account of what the reward to risk of doing so would be. And so a lot of the results that we have is once you have a model of behavior and a normal model, then to look at deviations from that model itself and try to force people to take rational decisions with small reward to risk itself could lead to what appears to be a lot of behavioral biases that are really not behavioral biases, but just not worth it to undertake those activities. So things all merge together and thinking when you start getting involved in thinking about these problems. So I've been sort of excited about some of this research. Now, really, I think that the way I look at things, that there's, in performance measurement, going back to performance measurement, generally the way performance is measured is there's a benchmark or a basis so that you can have, such as the S&P 500 or the MSCI World Index, and we have a benchmark. And then people are evaluated relative to the benchmark. And on average, do they do better than the benchmark? So everything is averaging in our business. We take monthly returns and we take the returns that we achieve on an investment portfolio relative or minus what the benchmark return is, and that gives us a return for that month or period, and then we say on average is the performance better of this manager or that manager to the benchmark. And so we define success as either the information ratio. The information ratio is just the difference in returns in our portfolio minus the benchmark divided by the residual error or the difference, error of the difference, and see whether that's significant. So the information ratio is used everywhere as a way of judging performance. In addition to that, you have the Sharpe ratio, which is the slope or the reward for this portfolio minus the risk-free rate or interest rate divided by the volatility. Everything is based on one period average models, okay? And so the interesting issue is that what we have done has changed return, or the way to think about returns, from absolute returns, which is trying to think about increasing terminal wealth, to relative returns. How am I doing relative to someone else? Am I outperforming relative to someone else? And the interesting issue, in my view, is that this relative performance evaluation does really not foster long-term investing. The tracking error, or the inability to deviate too much from the benchmark, and the itself, or that constraint, that tracking error constraint itself, has a cost, and that's what I want to talk about today. And it really does not allow for dynamic risk control. It does not allow for long-term investing, but it does control cheating. It does control really monitoring costs a lot, because if I say to you, stay close to a benchmark, and I ask you to stay close to the benchmark, then it means I don't have to worry so much about what you're doing and what risk you're taking and how far the investment manager is deviating from the benchmark. So in a lot of science we know there's incentives and there's penalties, the carrot and the stick, but we have to be able as well to measure. And so with lots of measurement costs and measurement errors, then creating a benchmark does reduce as a substitute for the tracking error is a substitute for the cost of measurement. So basically, the way I look at things is that there's a trade-off, and what I really want to look at today, and what I've been thinking a lot about over the last number of about a year or so, is the idea that we have direct costs or explicit costs in monitoring others, managers or other people, but additionally, we can have constraints that we impose on them which reduce the direct cost. But the interesting question to ask is there an implicit cost, not an explicit cost, in imposing a tracking or a benchmark? The implicit cost is, do you give up returns? And what returns do you give up by imposing this tracking error constraint? If you have a tracking error constraint, then is there a lost return relative to the optimal situation if there weren't costs of monitoring, there weren't costs of measuring others' performance? So I think really that in my way of looking at investment, there are, and all tracking error has an effect on these dimensions, the idea of trying to stay close to a benchmark or have a constraint to stay close. One is that we make returns by holding inventory. Obviously, all securities have to be held by someone or some group of individuals. And so we hold inventory, such as holding index funds or holding other types of diversified portfolios. And the interesting part about holding systematic exposures, if you hold an index fund or you hold a portfolio, that the risks of that portfolio are not constant. Even though you're holding the inventory and you're carrying the risk forward in time, the risks of that holding is not constant. So the interesting issue is, what are the costs of ignoring the fact that risk is changing? So absolutely, and that inventory is being held, but as an investment, individual holding investments, is there a cost of what is the risk dynamics of holding that, of holding those portfolios? The second is that alphas. We call making returns in investment and trying to judge managers and their ability to outperform, to pick securities. So we call that alpha. Either they can forecast the future or they can forecast the far future, and they make returns by turning over inventory. So they're proactive. They're deciding on how to make money. And most of my students and others, we think about making returns in finance. We think about alpha, or the idea of forecasting the future and being able to earn returns that way. And the third way of making returns in the investment world are really the intermediation services. Large amounts of money are made because investors do not understand risks and they want to change their holdings, and they know they can be giving up returns by asking others to take the risks and move them forward in time. So the whole intermediation business that exists creates an opportunity for investors to earn returns if they can provide intermediation services. And I call this not alpha, but omega. It's reacting to opportunities to make money, reacting to opportunities to make money because others do not want to hold those risks. They want to provide risk transfer. And as we know in finance, markets are asynchronous. The idea that there's could be supply-demand imbalances here at one point in time, and that basically an intermediary steps in and holds the inventory and carries the inventory forward until such time as someone else wants to acquire that inventory. And that's a standard part of financial intermediation. The markets are asynchronous, and intermediaries step in to make them appear more synchronous, and hedgers pay speculators. Speculators carry risk forward. They make money by doing it. So many hedge funds or many other actors in the market are actually in the business of making money by actually carrying inventory or risk forward, just the same way as the farmer sells crop to the miller stores the crop or the inventory until the consumers buy the bread and cakes from the bakers. But in so doing, the Miller uses the services of speculators to carry risk forward and in the marketplace. So basically, that's a reactive business, reacting to opportunities to make money. So I think sustainable investment businesses are these omega businesses where intermediation services, where it's carrying risk forward and others knowingly give up returns to doing it, and that the suppliers, that the intermediaries who take risk forward in time make money doing that. So I think, however, that one of the problems with this intermediation services or business is that you have to be willing to take lots of deviations from a benchmark, which requires that investors have trust of the intermediary who's raising funds from investors. And so such activities as distressed debt, such activities as mergers and arbitrage or spin-offs, all the things we get and sort of thinks of as anomalies in the market are really part, I think, of the compensation of intermediation services, but also of constraints. The fact that to be able to have capital to perform those services, that it's necessary to take a lot of tracking error. And if you take a lot of tracking error from a benchmark, because reacting does not give you the benchmark. If you take tracking error from the benchmark, that means that it's hard to measure the skills, and as a result of that, it needs to have an ability to garner trust of investors, which means that you have a limited supply initially of speculators, and they have to make rewards from undertaking their activity. So there's tracking error. Tracking error occurs in that model. Anytime you have a tracking error situation, anytime you have people going to deviate from the herd, then I believe then that creates opportunities to make money, but it also requires that you have a situation where investors those who are successful have to be able to attract investors who trust them. And because of the tracking error constraint, I believe another sustainable model is really to pick longer term themes. When investors invest, to take tracking error or the idea to deviate, if you really believe that companies are undervalued and it takes a long horizon to actually invest in those companies, then the long horizon investor is different from the one who's a short-term investor. So I think it does, the tracking error model does foster short-term investing. And so I think basically, and the third dimension is that if you have tracking error constraints, it really prevents investors from adjusting the risk of their portfolios of inventory they're holding. And I think that we have to go back and really ask the question about what affects our terminal value of our portfolios, and not so much thinking about the relative performance. Because compound returns are really the most important thing. It's not average returns. Average returns are very different from compound returns. And we are been concentrating so much in teaching and our research and thinking about one period models, how to get the best portfolio in the cross-section. But we have forgotten the time. We've forgotten time. And so there's not only cross-sectional diversification, there's time series diversification. And we know the compound return, because of convexity cost, is less than the average return, even for normal distributions. So the idea that it's the compound return that really affects the value or level of terminal wealth. So what affects compound return is really fat-tailed events. The idea that the distributions of returns that we have are not normal, that the distribution changes over time, and fat-tailed events really affect compound returns, and maybe not very much average returns. In other words, if you have 100 observations or 1,000 observations, on average might not be very different, but really the tails of the distribution, either the left tail or the right tail of the distribution, have a huge effect on compound returns. And I'll show that in a moment or two. And also, interestingly enough, what is not understood is if you have a level of risk that you want, let's say that level of risk is at a set level of risk, given what you have in your opportunity set, if that's your risk you want, allowing your risk to fluctuate around that level of risk that you wish actually reduces your terminal wealth. So even though we have an index fund, we hold an index fund, such as the S&P 500, if the risk of that index fund is not constant, even though on average it's constant, then the risk we want on average, allowing your risk to fluctuate around that average reduces your terminal wealth. And so I think we have to not only think about cross-sectional diversification, which I don't think is that important. In other words, if you pick securities or compose your portfolio with different classes of assets, some do better, some do worse. On the cross-section, on average, it's not going to make that much difference because you have a lot of things you can average in the cross-section. But the problem is over time. And time, we only have one pass of time in thinking about risk management. And so I think that basically we have what we have in portfolio management today, endowment funds, wealth funds, universities, investors generally, consultants, talk about really static asset allocation models. They say, let's allocate, for example, 60% to stocks and then 40% to bonds. And within stock categories or growth categories, what we'll have within growth categories is maybe we'll have some hedge funds, we'll have private equity funds, we'll have long equity funds in the cross-section. Within bonds, we'll have G7 bonds or other types of bond instruments in that category. So 60% in stock and 40% in bonds. And then what happens is that once a month or given deviations of the stock performance from the bond portfolios, then the portfolio will be readjusted. So either implicitly there's an assumption of mean reversion that when stocks go up, you sell them. When stocks go down, you repurchase them. And so that static allocation strategy maybe on average over long periods of time give you a risk that you want, which is about 60% of the market. But the problem is that at times a 60-40 strategy could be 90% in stock in terms of the risk associated with the portfolio. At other times it might be only 20%. So the interesting issue is, can you dominate the 60-40 strategy and thinking it economically by having dynamic risk allocation strategies which actually try to keep time diversification or keep risk constant over time as opposed to static market weight strategies. Now you say to me, not everyone can do a dynamic risk strategy, but the problem is that if most of us are stuck in the world of 60-40 because we can allocate money in a way that is easy to measure, 60% in stock, 40% in bonds, and we can then take a 60% stock bond weight and look at the performance relative to that, then there is opportunities to actually make money by keeping risk constant over time for investors. And I call objective-based strategies as the third dimension, which is really, do risk appetites remain constant over time? Because we have to think about how risk changes over time. And most investors, when they have delegated investment management, requires that you satisfy boards. So when you have a situation where you have great losses in your portfolio, then many investors do not sustain their positions, and also many managers are let go or fired as other managers replace them. So basically, a lot of investors wish to have strategies or portfolios that have optionality to it. When they're making money, they're willing to take more risk. When they're losing money, they want to take less risk. So we have to do a lot more thinking about time and the dimensions of risk management and thinking about risk management over time. So if we look at various things that have been done in finance to keep risk constant, benchmarks are really average risks, and risk in the benchmark is not constant. And really, if we want to keep risk constant, unless it's optimal to deviate in our risk-taking abilities. So you have a situation where, if you have various models are trying to think about replacing just market weights as a way to think about investment, or benchmarks as a way to think about investments. And several models, such as risk parity models, have come into place where a lot of money is now being managed by using risk parity. And risk parity models attempt to keep risk constant using volatility measures. The problem is that volatilities, of implied volatilities, are not constant. And second is that you're using a lot of historical data to estimate volatility, so you don't even know what period of time to measure volatility over. And third is that volatilities tend to spike at times of shock, as correlations are not constant. And using historical volatility and historical correlations themselves, assuming they're constant, is incorrect because of the changing nature of correlations. And we have to include that in our thinking. And they assume in the risk parity models that returns are proportional to volatility. On average, if you look over long periods of time, the returns on various asset classes that are proportional, seem to be proportional to the volatility, approximately. Higher volatility assets earn more, lower volatility assets earn less. But that's not true in the short run. Over shorter periods of time, that can't be true. And it can't be true that correlations are constant, and it can't be true that volatilities are constant, and it can't be true that, or if it were, these correlations were constant, then obviously the risk parity models couldn't apply, because the only way they'd apply is the extreme case where we had shocks and all assets were perfectly correlated, or else we'd be able to take a portfolio and be able to, if assets had returns proportional to volatility, the portfolio would have much less risk and higher rates of return. But the interesting issue is to think about what the most important risks are, and I'll get to those in a second, which are tail risk. And they're hard to measure because there's few events, but you can have a wonderful market in forecasting tail risks and tail events, and that's in the options market. The option market gives us forward estimates of actual risks and how risks are changing. And I'm going to just describe that in a moment as to how using forward-looking estimates give you better estimates of risk than risk parity or other measures, which actually just look at historical returns. If we look at the benefits of time diversification, we can say, let's assume that we're an investor, and the investor without skill, randomly invests fully in risky stocks 1/2 the time, and in riskless bonds the other 1/2 the time. And basically, if you look at that, 1/2 the time they're fully invested in stock risk, and 1/2 the time they have no stock risk, versus another investor who invests in stock and bonds 50-50. Now, if you have no skill, basically you randomly bounce between bonds and stock, then it's the case that the average return on those two strategies, the bang strategy going between stocks and bonds, the average return is exactly the same in both strategies. Sometimes that's interesting to think about, because if you're in the stock market, you get the expected higher return of being in stocks. You're in the bond market, you get the return of being in bonds. So even though the risk of the index is changing, and you say, oh, I'm compensated because I get a higher rate of return, that on average, if the risk you want is is constant risk strategy, what happens is even though the expected returns are exactly the same in the two strategies, that the volatility of the bang bang strategy, the bouncing between stocks and bonds, is much higher than the volatility of the constant risk strategy. So you end up having a lack of time diversification. And the volatility of the variable strategy is about 0.71 of the volatility of the market, while the volatility of the constant risk strategy obviously is 1/2 of the volatility of the market. So you ask yourself, so what? But basically, we know the following, that if your average returns are the same, then your compound returns are going to be less by the increase in volatility that you have. So if you look at just the strategy that I looked at here, is exactly the strategy and replicating it from January 1988 using daily data to through the end of 14, the end of 2014. And basically there, with both strategies have the same expected per period return, because every day I just randomly went between stocks and bonds, 100% stocks, 100% bonds randomly each day, and versus one of keeping 50-50 in stocks and bonds all the time. And what happens, you see the compound return, because compound returns are affected by volatility. There's convexity costs. The convexity costs reduce compound returns. So allowing lack of time diversification or allowing risk to change in this way reduces your compound returns, 4.7 in this case versus 5.4% per period. So the terminal wealth is much affected by actually allowing your volatility to increase. As we know, the compound return is generally less than the average return by the volatility effect. And so that's one effect, is just the lack of time diversification itself affects compound return, which affects terminal wealth. And we don't consume relative performance, we consume actually terminal wealth or terminal value. If we look at the tails of the distributions and compound return and effects of tails on the distribution, it's really the case that extremes, either missing the upper tail of the distribution or suffering the loss of the lower tail of the distribution, has the largest effects on terminal wealth or terminal value. And relative performance measurement, you ignore the tails at all, because if someone else is losing a lot of money in the benchmark and you're losing a lot of money in the benchmark, that's fine, because relatively you might not be losing as much. So I looked here at the distribution of returns on the MSCI EAFE index since January 70, and the commodities since 91, I had data, and global high yield from 1990. We see the distributions, the circles show obviously left tails and right tails relative to the normal distribution, which is the histogram is superimposed on the normal distribution, or the fat tails. And if you look at sort of a 60-40 strategy back to 1930, start of 1930, basically there, the 60-40 strategy adjusted back each month, which is the common strategy that people use in asset allocation, is basically you have the fat tails of the distribution again, and on average, they get washed out. I mean, the fat tails get lost. You have the upper tail and the bottom tail, which tends to be more extreme losses, but relative to normal in the strategy. And I have in the box that's there, those are the 10% of the worst cases that had occurred each month over that period from 1930. But then in the right-hand part of the graph, I say, what is the growth of a 60-40 strategy? If you invested $1 US in 1930, that $1 would have grown to $680 by the end of 2012. On the other hand, if you could have reduced the risk of the left tail of the distribution by a third, just a third of the risk, that loss, your $1 would have grown to $4,900. And if you could have reduced that, which may be impossible to do, by 1/2, you would have had $13,000. So in that same $1 investment, just the 10% of the worst months, eliminating 50% of the losses, reducing the loss by a half in those periods by reducing your weights in the portfolio to reduce that loss would have grown to 13,000. I'm just giving this as an illustration to say how important it is. The tails of the distribution are in affecting terminal wealth. The tails of distribution are much more important than whether you pick a stock or whether you allocate to this country or that country in terms of increasing your terminal wealth, because they have the greatest effect on terminal wealth, not on relative performance, but on absolute performance. And so that has a huge effect on it. So I look here, I did another study here just to show you the effects on terminal wealth. But tail events are infrequent, large negative and positive returns. And volatility is really frequent, small positive and negative returns. Volatility is just randomness, random things. But tail events are infrequent, and they have large effects on portfolio performance. So what I did here was just to say, if you think about one pass of time, and what happens with time versus the cross-section, then it refocuses the attention of how we should be thinking about investment. So example here, what I did was take 3 standard deviation moves on the S&P since 2004 to December through 2015. And we had a lot of 3 standard deviation moves over the period, obviously in 07 and 08 in particular. But what I did was say, let me do the following. Let me take the 3 standard deviation moves on the left tail, the 3 standard deviation moves on the right tail, and get rid of them, okay? So the extremes of the distribution. And those, and look at the terminal wealth. So compound return, 8% if you include everything. If you exclude just the 2% of the winners, 2% of the losers, that are the 3 standard deviation moves, that you have a 10.2% compound return, much greater compound return. So basically, 2% of the observations that we have represent 25% of the impact on terminal wealth. Obviously, if you go over time, like a friend of mine said, Myron, I can't swim. Can I cross this river? I say, yeah, sure, you can cross the river. On average, it's only a half a meter deep, okay? But you go on the 10-meter part of the curve of water, you're dead. And we assume in all portfolio theory, all we teach, all we think about, is you can cross the river many times. On average, fine. We can keep crossing the river because we assume that you always only invest $100, okay, each period. And that's what we assume because that's what the average is, not the compounding effect. So if we drown, we don't get back. And it has a huge effect on our performance and a huge effect on our terminal wealth in those particular areas. So you have a strategy, one of the strategies that's very common that people use, which is the carry trade. The carry trade is a very, very common strategy. It has the optionality associated with it. But the idea that let's assume that I have strategy A and strategy B that have both the same average return, 7.7%. And the mean return on 80% of the days in the simulation that I did was 0.29%, or almost 0.3% a day. And the strategy B, however, only made 0.13%. Both strategies have the same, but on the mean return on the 10 worst days was 10% of the worst days on strategy A was 3.9% negative, and strategy B 2.6% negative. And the mean return of the best days was the same, 1.9% in both cases. So they have the same average return. The distribution is moved to affect that. But even though 10% of the worst days, on 80% of the days you're better off, right? You make 0.29% versus 1.3. So your average return is the same, but your compound return is, in strategy B, is almost a percent higher than in strategy A, because on those worst days that you lose that extra money, it takes you a long time to recover. And that's the major difference. So even though we ignore or try to ignore the tails, okay, they have a profound effect on terminal wealth, which is much different from average wealth or average returns that we talk about. So the interesting issue is that we want to think about measurement, and we want to think about proactive risk management or thinking about things. One thing I realized is that, since I love options and that sort of thing, obviously, is that, why not? Is that people have always talked about options, and we look at estimates of future volatility or future risk from the options market, and we estimate the volatilities of volatilities, okay, is high. The interesting issue is that what can we learn from the option market? Do we learn from the option market to think about volatility all the time, volatility, or can we learn from the option market how to think about these most important risks in compound return? Compound return, which is based on the idea of having the tail risks, okay? Can the market actually forecast for us when tail risks are increasing? Because you think about the option market, first of all, there's a wonderful paper by Poon and Granger who actually in 2003 did a survey of all of the papers on forecasting volatility, whether it's Garch models or other types of models to forecast volatility. And their paper concluded that the best forecaster of future volatility actually was from the option market. And the interesting enough, that if you look at the distribution of returns, okay, that we know the option market is segmented. In other words, we don't get the same volatility estimates in the market for in-the-money options as we do for out-of-the-money options as we do for out-of-the-money options. There tends to be skewness in the market a lot of the time. So we don't get the distribution that we'd have under the Black-Scholes model or where we assume constant volatility. And so the interesting point is if you look at the out-of-the-money options, take the out-of-the-money put option. The out-of-the-money put option has to be insurance. You're insuring someone in the tails of the distribution. Now, we know if you're insuring someone that if the price of insurance goes up, then it must be that someone's forecasting that there has to be greater tail risk. So the interesting issue is there's smart money in the tails of the distribution which actually give good estimates as to future risk, future tail risk. And so if it's the case that many people that are doing benchmarking or relative value, even though they might know risks are increasing, they can't do anything about it because that's their benchmark. So they're stuck at the benchmark. So if the constraint is sticking to the benchmark is high, then there's a cost of not using this information in the option market to adjust your risk of your portfolio to take account of the fact that the market is telling you that there's an increase in risk of tail loss, and the increase in tail loss is going to reduce your compound return, even though on average you're going to be fine. It's like you're drowning and someone else is drowning, but you're not drowning as quickly as they are. You're happy, and that's the real problem associated with relative value invested. You're drowning less quickly. So basically, the tails of the distribution. So why do I think that tails of the distribution have where the smart money is? Okay, at the middle of the distribution, you have a lot of different investors who are having a lot of short-term or volatility, but it's really the tails of the distribution that have the most information, in my view, because if you're writing options in the tails and you're a market maker, it's a levered market. To survive, you better be very smart. You don't want to wait an option, and those who are buying options are protecting against risk event. My mic wasn't working as well. Anyway, so and the same is true in the upper thing. I depicted 3 distributions here, like the left tail, the middle of the distribution, and the right tail of the distribution to actually look at prediction measures. So I think that the interesting issue is that I've been doing research now in trying to say, can I use the information? And I'm not going to present that today as much, but the answer is yes. I mean, the idea is you can use the distribution of returns as forecast by the option market to tell you how the risks are, expected risks are going to change in the market. So combining these estimates allows the portfolio to change in such a way that you can reduce the convexity costs, reduce the cost of tail risk, reduce the cost of excess volatility. And I think the reason that you can do that is because of the tracking error constraint. If the tracking error constraint didn't exist, this benchmarking didn't exist, then obviously the whole market would adjust very quickly. But if you're stuck, constrained, then the idea is, can you then adjust risk? So I think there's a lot of research to really be done in thinking about convexity costs, thinking about how to think about dynamic risk management, how to think about time series, going back to time series and forgetting about entirely about just thinking about the cross-section alone. So the second thing I'd like to talk about in terms of tracking error is a paper that I have, again, that I've been working on, that I have and basically the anomalies that we get in a lot of our capital market pricing. The idea of papers that I wrote, with Black, Jensen, and Scholes, and then Macbeth, and then Hagen and Hines, and others, and other measures of uncertainty such as volatility and idiosyncratic risk, and then French factors that we have, and then Chen, Ross, and Roll arbitrage pricing factors, obviously say that things like the standard capital asset pricing model, which says that the only important risk is beta, does not tend to hold. The capital market line is really flat. And then we get underperformance of stocks with high idiosyncratic volatility extends to international markets as well. It also, low beta outperformance of high beta stocks is the same in global fixed income, commodities, currency markets across multiple asset classes and geographies. And also, so we have findings generally that not only does total volatility matters, idiosyncratic and systematic. And so there's, how do we explain this? One way is to explain it by anomalies. The market is anomalous, okay? The second way is to explain it is risk factors, a la French, just infinite number of risk factors, and we don't, but that's sort of more data mining and trying to think about why what we haven't really explained why those risk factors exist. And then another explanation is behavioral explanations, which are like Schiller or others in that camp, where investors like lotteries. So they bid up the prices of high-risk stocks because they like lotteries and they like the winners and they know they're overvaluing it, but basically they'll have a chance to win. And the problem is we have arbitrage or institutional investors are not the ones who would tend to arbitrage this difference because basically they worry about losing clients if they have too low risk in their portfolios and the like. But our model, our model, the tracking error constraint model, really says that, will show that the institutional investors are not the arbitrageurs, they're not the right clientele to actually sell these high-risk stocks because they're the demanders themselves. So they're the natural clientele for high-risk stocks because of the tracking error constraint. And I'll explain that in a second. The interesting, and the other explanation is the leverage argument. It seems to be very popular, where it's the case that, do this. Okay. The leverage argument, which seems to be popular. Initially, when Fisher, Black, and Jensen discovered the flatness of the capital market line, and Fisher Black had a paper on it, maybe that it's the case that the flatness of the capital market line was due to the fact that investors wanted to buy higher risk stocks as substitutes for inability of the cost of using leverage. So leverage is beta in a lot of ways. It's not idiosyncratic risks. And we know now that with the great institutional advantages of being able to use levered ETFs or to use futures and that, really the cost of leverage has fallen quite dramatically over time, using leverage over time. So the basically a paper that I have with Ashton Alencar and Peter Blaustein and is that investors rationally constrain their active investment managers because of the tracking error constraint is less costly than explicit monitoring. So if you explicitly have to monitor people, it's hard to evaluate them. Investors actually, managers like to have the risk constraint. If you're a stock picker, you don't want to have to worry about risk. You just like to pick stocks relative to your benchmark, and that's your skills and what you're compensated for. And the whole decision on asset allocation is left to a Stanford University to decide how to allocate its endowment money, or to CIC in China, how to allocate their money. They use consultants to make that decision. They hire managers for each bucket to outperform in each bucket, but the basic asset allocation decision is left to them, and they have consultants, and the consultants actually will then say which of the managers that they can choose are superior, and so everyone is evaluated relative to benchmarks. And even to start a new fund or a new activity, it's necessary to have a track record or to have a period of time where you actually would be evaluated before you are selected. And so managers want constraints in a lot of ways as well, because they think they have skills in what they do and picking particular securities. So it leads to implicit or explicit tracking error constraints. And it's really existed for many, many years. And it exists implicitly and explicitly. All of us want to be evaluated relative to us. And so classrooms, when we get evaluations, you grade on the curve. You're doing relative to someone else, not absolutely how you're doing. So we test, we say, let's have tests, okay, and let's have them monitor. But we don't know if anyone's learning, but we know that relatively everyone's doing fine. But we don't know absolutely anything. So absolute is good too. We have to go back to absolute. That's the way I tend to look at things. Okay. So when you're the new dean, you'll be evaluated relative to the old deans. But we absolutely don't know how you're going to do. Congratulations, by the way. So actually, Roll in 1992 and subsequent paper in 2000 and Brett and others had this idea. Impose a tracking error constraint on managers. Allow them to deviate from the benchmark plus or minus, say, 5%, or with that residual volatility of 5%. But his model was really neat in the sense you have a benchmark, and so you have a benchmark with a tracking error constraint, and he allowed managers really to cheat by increasing risk, okay, and so they can outperform. If you increase risk, you're going to outperform. But he showed that you're still on the efficient set, okay, if you allow for a tracking error constraint and you allow managers to increase their risk, they'll just go up the constraint. So therefore, you see here the basic genesis of a model, because what you're saying is the more unconstrained I am, the more I let managers do what they want, the more cheating they can do, right? So the more, if I don't constrain you to do anything, I'm going to say, wow, I'm a great performer, but I was really, I beat bonds, but I did it, by holding risky stocks. The more risk I held over time, I'm going to do better. So in the tracking error constraint, anytime you allow for more tracking error, you also allow for more cheating. Because you're not, when you allow for a benchmark, you're not monitoring. you're not directly evaluating what they're doing and spending all the money and effort to try to understand how someone's doing something. What you're doing is saying, I'm going to use an external measure, and if you can beat that external measure, then you're doing fine. The question is then, that says, is that you have skill or do you have cheating? And you know, that's the interesting question. So he showed that these portfolios are on the efficient set, and basically we add to the role model in two ways, okay? One is we add to the role model in the sense of having a tracking error plus a liquidity constraint. In other words, managers hold cash to meet redemptions or to make investments. And also we had a tracking error constraint coupled with active management, an alpha portfolio, which is actually, what time am I supposed to finish, 10:30? Okay. Yeah, so I got my watch here. It says 8 o'clock, so I was thinking, still in California time. So with a tracking error constraint coupled with active management, or an alpha portfolio, the manager has skills, okay? And so either zero beta alpha portfolio or a positive beta alpha portfolio. And so implicit in the model, we have like K is the amount of whether you have, if you have a liquidity constraint, then K is less than 0 in the sense you hold 5% cash, okay? And if you have K greater than 0, then you have leverage. You can use leverage, and basically if you have K equal to 0, you have no leverage and no liquidity constraint. And so that we ask the question, does the tracking error constraint itself lead to a cost in terms of lost returns? The portfolio is not on the efficient set. So that's the question. You know, if you have a tracking error constraint, lead to cost in lost returns, and then it's an implicit cost as opposed to an explicit monitoring cost. And really, does the tracking error constraint itself have an alternative explanation to the underperformance of high-risk assets? Do many constrained managers overweight the higher risk assets and therefore affecting their prices? And so do investor constraints also have a role in explanations of the anomalies that we see? And basically, the models that we have, the major findings of the paper is, yeah, that they do. With liquidity and a tracking error constraint, the optimal portfolio is not mean revariance and efficient. And when you have a liquidity constraint, to compensate for liquidity constraint that you have, the manager actually will buy higher volatility stocks, okay, to stay closer to the benchmark and not deviate from the benchmark. And they add to higher holdings of risky assets. In the model, we'll show you that in a second. And with a tracking error constraint and a zero beta alpha portfolio, then what we find is that the manager tends to finance his investments with using lower volatility stocks. He holds his higher risk assets to control his tracking error. So if he has an opportunity to buy high risk stocks, low risk stocks, and medium risk stocks, how does he finance them? He finances them by actually liquidating the lower, or holding less of the lower risk stocks that have lower idiosyncratic risk and lower actual total volatility as well. So the greater the risk, and interestingly enough, which is really neat, okay, about the model, is that the amount of tracking error the manager will take is a function of the amount of reward, or alpha, to error of alpha. So the greater the alpha to the error of alpha, the more tracking error they'll take. Therefore, the more they'll try to mitigate the cost of the constraint by holding higher risk assets. So you have a trade-off between reward that you have for your skill versus how you mitigate the constraint. If you have a constraint, a shadow cost of the constraint, then you try to act to mitigate that. And so our model has dynamics. Unlike other models, which talk about holdings or risk management over time in terms of alpha, what we say is that when the shocks occur in the market, when the manager no longer has great belief in their alpha to sigma ratio, then basically, then there's no sense of not going back to the benchmark. So we see dynamics in the market where managers return to the benchmark. If the managers return to their benchmark, does that have an effect on higher risk asset prices? And the answer is yes. The evidence is very strong, either in the volatility space or in actual what managers themselves do, is that when it's the case that their risk increases in the market, or their inability to forecast increases in the market, they tend to go back to the benchmark. Higher risk securities tend to fall relative to lower risk securities because they're buying them in. And over time, as we know, that that's the same thing is true in terms of performance, that even though on average the mutual fund manager might not have performance, they do have skills but are lost to some extent by the necessity or the desire for them to hold higher risk assets to control their tracking error. So the model itself is, another page here. Okay. So the model itself, the problem is, the problem is really where X is the actual differences between the weights of the managed portfolio and the benchmark. So what you want to do is minimize the deviation of the weights subject to your outperformance measure G, okay, given your expected returns, and whether you have a constraint K, which is less than 0, which is liquidity constraint. And so we select the weights in such a way that, for example, K, if you can have K is minus 5%, which is the no leverage case, and that would be a case in which you're holding cash. And what we find is in the liquidities case, the cash case, that what the investor does, the weights, the deviations that they take from the actual benchmark depend on G, the outperformance you are trying to achieve, given the returns on two portfolios, and that's Q1 and Q0, where Q1 in the are two efficient portfolios on the mean variance efficient set, where Q1 is the minimum variance portfolio and Q0 is the minimum variance portfolio. That's the low risk portfolio, and Q1 is the portfolio on the efficient set where you take a straight line from 0 through Q0 and it hits the efficient set at Q1. In that case, then it's the case that Q0 and Q1 have the same reward to risk ratio, and because it's a linear projection. And therefore, what we show is that the second term is the deviation from the efficient portfolio due to liquidity constraint, and we call this the hedging portfolio or the risk reduction portfolio. And basically, it's an inefficient portfolio because it's a convex combination of two portfolios on the efficient set. And what it does, it leads to holding an inefficient portfolio. But what happens is with liquidity constraint, the manager actually shorts, if you think about it, it's neat because you get the separation, you short a low volatility portfolio, which is Q0, and buy a higher volatility portfolio, Q1, with a net position of K, which is less than 0. So you overweight high volatility holdings to counter the tracking error stemming from the zero cash holding portfolio. And what we find is with an alpha present in the amount of Q0, the low volatility portfolio is shorted to finance exposure to alpha. Okay, and there's also an interaction term between liquidity and alpha for both the zero beta assets. Without a liquidity constraint, the alpha and tracking error with constraint acts like a liquidity constraint. So but they multiply each other, and they're not substitutes. So when you have alpha portfolio and you have a liquidity constraint, they interact together. And basically, the solution that we get, which is outlined in the paper and the appendix of the paper, is the vector we get of X really shows the middle line there, which is in the numerator, is the amount of exposure to alpha, and given the liquidity constraint that you have, both of them together, and the numerator is really the vector of length n plus 1 assets. The first row in the length is the non-alpha assets, and the second one is the alpha assets. The denominator just normalizes this. A better way to look at this, just for our use here, is the simplified solution becomes this. If you assume no liquidity constraint, just there's no leverage or no liquidity constraint, you get k equals 0 in that case. And then the alpha position that you'd have is, given your outperformance, then it's interesting that the amount of outperformance you take, or the amount you take in holdings of your deviations, is based on your alpha to sigma strength, how much you believe alpha is to your standard error of alpha, divided by the amount of return you get on the zero risk portfolio, the minimum risk portfolio, divided by its error. And so that constraint, obviously, if you don't have no skill, you want to just go and buy in that portfolio, and then at the same time you'll compensate for low risk by actually holding a little bit more of the higher risk portfolio in your holdings. So what happens is that in these models you actually overweight the higher risk securities to control your tracking error. And it makes sense. The greater your alpha is, the more you want to take deviations, but the cost of the deviation, you're violating the tracking error constraint, and therefore you'll act to try to mitigate the tracking error constraint by buying higher risk securities, or financing what you want to hold by actually selling lower risk securities that don't have a greatest effect on your tracking error. Just quickly, in understanding leverage, I'd like to show a little bit of the empirical results in the time I have left, that if you have leverage in a situation, the first step, if you allow for k being greater than 0, what we do is allow for the first step is the outperformance target is achieved as if you have no leverage, okay? So that's the first step. So you're long higher risk portfolio, long alpha, and short the lower risk portfolio. The second step is if you allow for a leverage, then you can reduce your tracking error by using some leverage. But the interesting thing in the model is that you stop using leverage. Even though you can lever, and you can have leverage where k is greater than 0, what the model shows is that the manager would stop. What they would do is use some leverage. But the problem is, if you use some leverage, what you're doing is, if you have outperformance target, then second step is really to use some leverage, but what happens, you have to then take, you short some of the high risk portfolio, and you buy in the low risk portfolio, but at the same time, you're giving up alpha. So the interesting issue again is the reason it stops using leverage is because then you're just using leverage to lever lower risk assets that you don't have any skills. So interesting enough, the model, which is hard for me to explain in the time I have to do it here in great depth, is the issue is when you have a lot of alpha skill, then you don't want the manager to use leverage, because basically then what they'll do is they'll substitute away the great alpha skill and just increase risk by using leverage, the cheating part. So if they have great alpha skill, you want to restrict the amount of leverage they use. If they don't have great alpha skill, or the alpha to sigma is low, okay, then you want to use leverage to amplify, but you'll still stop. So, the interesting issue, what do these implications have for corporate finance and the use of leverage, and why you'd see different leverage between high skill and high alpha to sigma skill ratios versus lower alpha to sigma skill. So these are interesting. So let me give you just quickly sort of the empirical results we had in the data. We had 95 active mutual fund managers with greater than 500 million of assets, initial assets. and we had daily return data from 1999 through June of 2010 without really knowing mutual fund holdings, okay? And so we had quarterly data which actually had their holdings from June to June 2013 over the same period. So the benchmark really was the S&P 500, as they stated, so their betas were around 0.93 to 107, and their tracking error was in plus or minus 10% range. Now, the interesting part here is that we want to construct, without knowing their holdings, how can we construct a tracking error index, okay? And so what we did is we looked at the just the daily data, and we took the 30-day moving average of, this is just to show you, the tracking error from the fund benchmarks are affected by differences in holdings and the single stock correlations. In other words, if you have a benchmark and you deviate from the benchmark, then how is your tracking error affected? One, your tracking error affected by the actual fact that your holdings are different, but their tracking error is also affected by the volatility of these stocks that you're holding that are not exactly in the benchmark. So the two, we had to separate these two things, and so if you just look at the actual moving average, just to show it over time, that this is the tracking error from the fund benchmark. So it's not constant over time, and it might not be constant because the correlations are changing over time. So what we did is we used the S&P to figure out its tracking error, and this is the measure of single stock cross-sectional correlations. And so the high value in the cross-section implies cross-sectional correlations are low. But, and so we measured the S&P tracking error by looking at the single stock correlation, cross-sectional correlations. And then what we did is we regressed the mutual fund tracking error and the market tracking error to get a indication of the fact that it's a common component, the systematic component, because of single stock correlations changing. And the residual itself represents the tracking error stemming from differences in holdings, not from changes in single stock correlations. So we're trying to look at the mutual funds and how they changed their composition of their portfolio. And so we get something like this, which is that at times of shock, before, like in 1999 and 2000, in the dot-com era, the managers deviated quite a lot from their track. They had large tracking error. And then in the 2001, 2002 period, they reduced their tracking error quite dramatically. Then they increased it over time. In 07, 08, they reduced their tracking error again and then increased their tracking error subsequent to that time period. So managers are actively changing their tracking error over time. And so what we did next was to look at the actual holdings, okay, over time, and to measure their returns and also control the returns for tracking error constraint. So what we did is look at the differences in alpha and betas between their performance and their actual returns. And we formed an aggregate mutual fund portfolio by using weights at the end of each previous quarter on aggregating the 95 funds together. So if you look at over time, what you find is the heavy blue line, okay, is the market weighting of the high mutual funds which have the high volatility stocks versus the S&P 500 high volatility stocks. So what I did there was just take the S&P 500, look at its composition of high volatility stocks based on market weights, and then look at the holdings of the mutual funds of the high volatility stocks. And during the tracking, during the dot-com time, high volatility stocks were really overweighted by about 20% in the relative to the market index during the high volatility, during this, that time. And then if you look at, fell dramatically, almost to zero, in the December '01, December '02 period when the market collapsed around that time, then increased again, and then in 2008, in December '07, it almost went back to zero. So mutual fund managers went back to their index at times of shock. You know, they tend to go back to their index. If you look over time, on average, you see here that the low volatility stocks in the S&P in market value represent about 66% of the market weight are the low volatility stocks, and mutual fund groups hold only 56% of the low volatility stocks. And the mean difference over time was around 9.8%, so that 9.9%. So that basically mutual fund managers on average hold higher volatility stocks, on average hold higher volatility stocks in their portfolio, and quite significantly so. And if you look at the return differences, if you look before, and actually there's slight positive alpha performance of their portfolio returns for each of the high volatility, medium volatility, and low volatility groups. Okay, so they have selectivity. If I run a regression of the aggregate performance of these 95, you bought a portfolio of these 95 mutual funds. That's what you're holding over time. That the intercept was slightly positive and insignificant. By the way, this is only looking at their holdings at the start of each quarter. I bought a portfolio at the start of the quarter and held it for the quarter, liquidated the entire portfolio, and then bought the mutual fund holdings again as though I was holding that aggregate portfolio. And then I ended up with, again, insignificant intercept, a very high R-squared relative to the S&P 500, slightly greater beta than 1 because I didn't include cash holdings that they had. And interesting, though, when I added in their overweighting to high volatility stocks, okay, then what happened was they had a significant intercept. Their quarterly returns were higher, positive, and but they had a lost return through their overholding of the higher risk securities. So if you divide this by 10, basically on a quarterly basis, they were losing about 3 or 4% a year is lost by just by having the tracking error constraint, by having a tracking error constraint. Interestingly enough, this is when I do some of my empirical work on not keeping risk constant over time, not keeping risk constant. When I do that as well, that's about the same loss on an average basis, that you get 2 or 3% a year in opportunity loss by not trying to keep your risk constant. So the tracking error constraint does have quite a large cost in my view. And one last test here that I'll do is that this one I just did using the Barra total risk analysis. This is dynamics of the performance of low minus high volatility stocks using the Barra MCI total risk sorted portfolio returns during periods of high uncertainty and shock periods. And this is the quarterly data that we had between 2000 and 2013. So basically what happens is that the overweight to, it's the question of the average overweight. I put a dummy variable in if the overweight was greater than, greater than 5 vol points, and what happens, and then the overweight when it's less. So what it shows here is that basically, and very significant, is that on average they're overholding the higher volatility stocks, and that has a negative return. But at times of shock, the higher volatility portfolio actually underperforms the low volatility portfolio because as a function of the changes in the mutual fund holdings, because mutual fund managers are selling high volatility stocks and repurchasing low volatility stocks to go back to the index. So the dynamics here are that the constraint itself and the alpha constraint interaction are very positive and have an effect on asset prices. So my belief is that some of the constraints that we have, or these constraints, actually can explain the anomalies or the fact that the high-risk securities are underperforming. I'm just asking us to think about, we have investment managers. I talked about two constraints today, major constraints. One is the constraint that the relative performance ignores convexity cost, ignores absolute returns. That constraint has a cost. And basically, over time, that constraint reduces return because we should be concentrating on absolute return and not relative return. Relative return is much easier to measure than it is absolute return. But absolute return has a cost in terms of implicit cost in terms of loss return. Also, the imposition of a tracking error constraint has a cost, an implicit cost in loss return because of the fact that the manager is constrained to stay close to the benchmark and cannot use their alpha skills to their ability to outperform in an unconstrained way. So the interesting issue is that that if it's the case that we have dynamics in the use not only of leverage, but we have dynamics in the use of actually buying or selling high risk stocks, then we have evidence here that the effects are on higher risk stocks. And so, I think that it's these alternatives or these constraints, or how to think about constraints on investment managers, are an alternative way to think about how anomalies arise and what actually the monitoring costs are of delegated investment management. So I'll stop there. Thank you very much.